Hi everyone, welcome to today's session. My name's Emily. I'm glad you decided to join me today. Today we're going to talk about RRSPs versus TFSAs. Our agenda for today is as follows. We're going to go through the various characteristics of RRSPs and TFSAs, as well as some tricks and tips. In part 2 of the video, we're going to spend some time on an example, okay? And in that example, I really want you to be able to see how you can use these tools to benefit yourself. So a registered retirement savings plan, or an RRSP, is a vehicle that lets you save for retirement on a tax-deferred basis. This basically means that you don't pay tax right away, but you will at some point in the future. The idea behind them is to allow Canadians to save for their future and take advantage of compounding investment income to grow their funds quicker without the burden of paying tax every year on the income. A tax-free savings account lets you save and save for retirement as well, but it's on a tax-free basis. So the investment income earned in it will never be taxed. Any Canadian resident who's under the age of 71 can have an RSP, but you must have contribution room in order to put money into one. And we will go over what that means in the next slide. The age limit is 71 because at this point, the RSP converts to something called a RIF, or Registered Retirement Income Fund. And we'll also discuss that a bit later. The main difference with a tax-free savings account is that a minor can have an RSP, but not a TFSA. You must be 18 in order to open a TFSA. Both of these can be opened at any bank or brokerage house. You can choose for them to be self-directed, or you can have someone manage them for you. So when we say self-directed, we mean that you're going to be the one to decide how your money is invested, what stocks you're going to buy, when to buy them, when to sell. If you have someone else manage it for you, then they will make those decisions on your behalf. You can also have multiple accounts, so you can open an RSP at RBC. You can also have another one at TD. Let's talk about some of the features of an RSP. Whenever you make a contribution, the amount of money you put in during the year is deducted from your income tax when you file your return the following March or April. So it helps you save tax at the moment. You can actually contribute up to 60 days after the year end and will still count as a deduction. So for the 2020 taxation year, as long as you put your money in on or before March 1st, 2021, you will get a deduction on your 2020 tax return. As I mentioned earlier, you need to have contribution room. The amount that you can contribute each year is based on your income from the previous year. If you decided in one year not to contribute, you won't lose that room. It will carry forward each year and it will continue to grow until you've decided at a later date that you wish to make a contribution. You can choose to contribute any amount that you want up to the contribution room limit, and there is no minimum amount. If you don't know how much you can contribute, you just need to look at your notice of assessment, and that's the document that the CRA sends to you each year after you've filed your taxes. The amount that you can contribute for the upcoming year will be shown on that notice. Make sure that you don't over-contribute, okay? Because there are penalties and these can add up quickly. If you get into this situation though, don't worry. You can pull excess amounts out, but there are specific steps that need to be followed in order to remove that over-contribution with no tax consequences. You can withdraw from your RSP at any time. However, any amount that you do take out will be included in your income and you will pay tax on it. There are two exceptions, and that's the Home Buyers Plan and the Lifelong Learning Plan. The Home Buyers Plan allows you to take $35,000 out to buy a qualifying home. But keep in mind that you do have to pay it back each year. If you don't repay it, you will have to include that amount in your income. So the idea is if you don't put it back, it's as if you had taken it out under normal circumstances, so you should have been taxed on it. The Lifelong Learning Plan is very similar to the Home Buyers Plan, but it allows you to take money out for education. So for a TFSA, these contributions are not deducted from tax. Essentially, you are using after-tax dollars to make your contribution. So what do I mean by after-tax dollars? Let's say that you earned $500 and you had to pay tax of $100. You would have $400 left. That $400 is what we refer to as after-tax money. What you can contribute to your TFSA is composed of three different numbers. So the first is something called an annual dollar limit. And this is an amount that is set by the government every year. For the upcoming 2020 year, this amount is $6,000. The second number is your unused room. So if you didn't max out your contribution in prior years, you don't lose that room. It will also accumulate and carry forward just like the RSP. If you were 18 when these vehicles were brought out, which was around 2009, I think, if you hadn't contributed anything, you would have room of 69,500. The third component is the withdrawals made in the previous year, and I'll talk a bit about this in the next slide. So similar to an RSP, there are penalties if you put more money in than you're allowed. And these penalties can add up quickly. They're 1% per month, so it can cost you 12% for the entire year on the amount of excess. There are no special forms and you don't need CRA's permission to remove the excess. So if you run into this situation, you should remove the excess as soon as possible. The CRA is starting to send out letters to taxpayers to warn them that they've overcontributed. So if you get one, make sure you deal with it. If you don't know how much you can contribute, if you have something called My Account with the CRA, then you can log in and check in there and it will tell you your contribution room. It will also tell you your contribution room for your RRSP. You can take money out at any time from your TFSA. And unlike the RRSP, it won't be included in your income, so there are no tax consequences. Anything you withdrew, you can contribute back into the TFSA, but keep in mind that you can't do that until the following calendar year. If you do it in the same calendar year, it will be considered an excess contribution subject to that penalty. So let's say you took out $5,000 in February of 2020. You can't put that $5,000 back in until January 1st, 2021. Watch your dates very carefully so you don't go over your limit. Any income that you do make in the TFSA is, if it's withdrawn, it will increase your contribution limit in a subsequent year. So let's say you started out with $10,000 in your TFSA and you made $2,000 in interest. Now you've got $12,000 and you decide you want to take it out. You can put all of that $12,000 back in the following calendar year. Okay, let's talk a bit about taxes. As we already mentioned, contributions to an RSP are deducted from tax. Therefore, the withdrawals have to be included in your income. There is a special rule that requires all RSPs to convert to something called a registered retirement income fund. And this happens by December 31st in the year that you turn 71. At this point in time, you are required to start to withdraw and include amounts in income. You can always choose to take out more, but you will be required to take out a minimum amount. There are basically no tax consequences to a TFSA. You've used after-tax dollars to contribute, so there's no tax on any of the withdrawals. The investment income that you've earned will never be taxed. So what happens on death? Benjamin Franklin said that there are two things you can be sure of in life, death and taxes. And it just so happens that on your death, you have to pay taxes. For an RSP, the entire amount left in the RSP or the RIF on the day that you die is included in your income. There is one caveat to that called a rollover, and that's if you have a spouse or a disabled child, you can put the amount into their RSP or RIF, and therefore the taxes won't be paid until their death. But it's still a tax deferral. As I mentioned, for a TFSA, there are no tax consequences, so no taxes to pay on death. Okay, let's talk about a few tips and tricks. I'm not going to go into too much detail about probate. We'll cover that in another session. But basically, when you die, there's something called a probate fee that you have to pay to the federal and provincial government. This fee is based on the value of the estate. If you were to set up your TFSA and your RSP and designate who is to receive these on your death, then you won't have to pay that probate fee. On death, these will go directly to that individual that you've chosen. This is important because probate usually ends up being about 3% the value of the estate, so it can add up. RSPs are often used for tax planning purposes. If you have a spouse, you can make a contribution to their RSP. This is beneficial when two spouses make different levels of income. So the higher income spouse can make a contribution and they get the benefit of the tax deduction on their return at a higher tax rate. And the theory is that the other spouse will be the one to take it out in retirement, and they will have less income, so it'll be taxed at a lower rate when it is taken out. So you should save money doing this because you save taxes at the higher rate, and then when the money is put in, and then it's taxed at a lower rate when taken out. Under the Canadian tax system, there are three types of investment income: capital gains, dividends, and interest. And these are all taxed differently. Capital gains and dividends are taxed at lower rates than interest income. What I want you to be aware of is when you put money into an RSP, you lose what we call the income characterization. So when you take money out of the RSP, it's all treated the same and it's treated as if it were interest income. So even if you earned capital gains in your RSP, it won't get taxed at the lower capital gains rate. It will get taxed at the higher interest income rate. So this doesn't mean that you shouldn't have investments that earn capital gains and dividends in your RSP. It's just something I want you to be aware of when you're meeting with your financial advisor or your broker and then you're deciding what you want to invest and where you want to invest. So let's go over some advantages and disadvantages. As we discussed, because the RSP grows tax deferred, your savings really utilize the concept of compounded interest, so it can grow a lot quicker. RSPs can be an advantage for people who have a hard time saving. Because of those tax consequences when it's pulled out, it is harder to access compared to a TFSA, and people are more likely to think twice about removing it. It's not always the case, but it can be a deterrent. On the flip side, that can be an advantage for the TFSA because you can access it in case of an emergency. It really all depends on you, your personality, and what your goals are. Keep in mind that both RSPs and TFSAs have some restrictions on the type of investments that you can hold in them. For example, you can't buy real estate in either. So they do limit you a bit depending on what type of investments you're interested in. As we're going to go through in our example, you will see that you can pay high taxes at death on an RSP. And as I mentioned, you lose the lower income tax rates on capital gains and dividends. Okay, so that's the end of our first session. We're going to break here and hopefully you join us in our second session where we go through an example. And the example is really important because, as I mentioned, it does really highlight how important it is to manage these investments for yourself.